and welcome to the Sanlam Investment Feedback Session. I am Zwashoniwa. I'll be your host today. I thought a good place to start today's session was just to remind our clients of what the Sanlam Umbrella Fund's purpose is. And this is to empower employees to be financially confident about their future. You'd have seen this tagline in a lot of our material over the past few years. And with everything that's going on around us and all the commissions and everything that we see on the news and on TV, I think we're in a time when trust and confidence are at a premium. So your trust as the intermediaries that are on this call and the partnership, that's been essential in upholding our shared vision, which is to accelerate a better working South Africa, where every worker, every family, and every community can be healthy and financially confident. Now, next slide, please. Now, as I reflect, on the past year or possibly the past 18 months, I'm reminded of the importance of partnership in achieving success, especially in the face of this complex and evolving landscape that we're operating in. Through a lot of the interactions that I've had with intermediaries over this period is just how difficult it is, engaging clients given all the challenges that our clients have, and also how difficult it is to grow their books. But your continued support and collaboration has been invaluable in helping us not only deliver exceptional value to our members, but also empower them to navigate an uncertain financial future. So on behalf of Sanlam Corporate, we would like to thank you for incredible support to the Sanlam Umbrella Fund, as well as your belief and trust in us. We're humbled and grateful for the ongoing support, which has ensured that we remain the fastest growing umbrella fund in the industry, where we've recently reached the 150 billion mark, as you see on screen. So you have our deepest gratitude, respect, and appreciation. Now, for today's agenda, we've included an economic overview from 91 and performance updates from Paul Wilson as well as Danny van Zyl. Now, we're privileged to have been joined by 91 today. Most of you would be aware that 91 is a globally respected investment manager with deep expertise across asset classes and markets. Today's discussion will provide valuable insights into the global economic landscape, which I know a lot of people are interested in. It changes by the minute, or should I say by the tweet. And we'll also touch on key macroeconomic trends that are shaping markets at the moment. Now, leading this conversation are two highly experienced practitioners, John and Malcolm. Together, they'll unpack the current economic outlook and share how they are thinking about opportunities and risks in today's environment. And as I've already said, it's an ever-changing environment. So with that, let me hand over to John and Malcolm to guide us through the discussion. Over to you, gents.
Good morning, everyone, and welcome to this brief macro update from John and myself. So it's been a crazy 2026, not quite how we all envisaged it was going to work out. And as we fast approach the halfway point of the year, there's quite a bit to unpack. And thankfully, for once, the craziness is not from South Africa. Our politicians seem to be keeping sort of under the radar. There's a lot happening globally, a lot driving markets, and we've all become experts on the Strait of Hormuz. We all feeling the inflationary effect of oil prices. AI is going crazy, and there's a lot of uncertainty about global growth. So, thankfully, we've got my esteemed colleague from London, John Stopford, on the line to unpack some of those issues and just give us a sense of what is driving markets and what risks are out there, and equally what opportunities are out there for our funds and our investments.
Morning, Malcolm. Thanks very much. Yes, so ironically, given, as you sort of teed it up, it's been a pretty crazy global backdrop. The global economy actually has been doing relatively well, particularly the United States, particularly Asia, Europe less so, sadly, sitting here in London. But that strength has been notably dependent on the AI boom. And AI is something that's going to affect all our lives. A lot of us are using it pretty actively already. But the big question for economies and for markets is whether that boom is sustainable and whether ultimately it pays off in terms of profits for the hyperscalers the AI labs, SpaceX, which is about to do its IPO, etc. So a huge amount of uncertainty about the profitability of some of those investments, but at the moment it's driving the global economy. And that is, as you say, against the backdrop of a major linkage in the global markets, the Strait of Hormuz, through which typically before the crisis, probably about 20% of the world's oil supply flowed daily. At the moment, very little is getting through. That closure has now been going on for months. And so far, it's pushed up oil prices, but there's this hope of a deal. And as long as the hope remains, markets seem to be able to look through the risks, but there are risks. So far, the impact, I think, has been limited. There's been other sources of supply, such as running down reserves. There's been some demand destruction, particularly in parts of Asia and parts of emerging markets. But if it carries on, those changes, I think, can't really absorb the loss of supply, and it will have an economic impact. So there is a risk that the market and politicians and others are too complacent. Donald Trump keeps telling us a deal is imminent. I think he's been telling us that since March. Some of his Iranian counterparties sound a little bit more skeptical, but there's clearly talk. So hopefully a deal will be done. That event or that backdrop has created some inflation. So clearly the direct impact has been higher petrol prices, higher oil prices. That feeds directly through to consumer spending, consumer baskets. It crimps people's ability to spend money on other things. But so far, it hasn't really had what are called second round effects. We haven't seen a material increase in broader prices, in wages. And part of that, I think, is because globally, the employment market doesn't look that robust. It's maybe a little bit better in some places than others, but there isn't a lot of wage setting power for labor. So most of the gains of the growth have gone to capital, they've gone to businesses, they've gone to investors. But central banks are going to be pretty cautious. They are concerned that, they've already had one inflation event in this decade, and they didn't handle it particularly well. There's now another. So they're sort of they've got the finger on the trigger, and we've seen some rate hikes, as you have in South Africa already. But that can maybe be repeated elsewhere. And if this crisis carries on, and particularly if it starts to have those second round effects, we might see more material interest rate increases. So overall, that probably leaves us a little bit cautious on equities, given valuations, given where growth is coming from and the expectations built into that. Makes us pretty cautious on some government bonds, because if interest rates are going up, they don't tend to do so well. But there are some markets where we are now pricing in fairly significant rate increases, both in developed and emerging markets, and those areas look more interesting. The chances are those pessimistic forecasts might not be realized. And the really bullish case for bonds, sadly, is if the global economy starts to really feel the pain from the Strait of Hormuz and maybe some worries about AI, and we go into a deeper slowdown. So unfortunately, to own bonds, probably you need to either be fairly neutral on growth or even somewhat pessimistic. But it's definitely, I think, looking like a more reasonable hedge against risk than it has done for some time. And then the dollar obviously is something that I think affects you guys pretty dramatically. It affects the whole world. We've been in a world for a long time where it's been very dollar centric, very US centric. Interestingly, this crisis should have been an environment that was pretty dollar positive. So if you think about it, typically people view the dollar as a sort of safe haven in times of crisis. Also, the US is now a petrocurrency. It's a net exporter of energy relative to a lot of other developed markets. That should put it in a stronger position. And yet, although we saw a little bit of dollar strength when the crisis first kicked off, it gave back that strength pretty quickly. And over time, it sort of looked pretty disappointing actually against quite a lot of other currencies, not least a whole range of currencies in emerging markets. So there's definitely a sense that the dollar under Trump has lost a bit of its shine. People have got a lot of money invested in the US stock market. They're looking for opportunities elsewhere. And I think at the margin, that's been helpful, I would say, for broad emerging market flows, broad emerging market risk. But you can tell me more. So I've probably spoken enough. Give me your thoughts on maybe how the global environment is impacting South Africa, South African markets, but also maybe a little bit of local colour. You've got elections and other things coming up, whether that's also something that's going to have an influence on your economy and your markets.
Yeah, thanks, John. And just to follow on from your point of the diversification of investors in the US, we are definitely seeing the benefits of that. We've seen the Rand very well behaved. If I think back to the 2008 crisis, 2015, when we were having in the throes of state capture, and you even go back to previous crises, whenever anything happened in the world, the Rand would go 2, 3 Rand, 3 Rand 50, sometimes even in a blink of an eye. Whereas we sold off a little bit when the war started, and the Rand has actually been quite stable. And I think we are seeing these inflows, and we've seen inflows into our bond market for the last 2 months in a time of crisis, which is something in my career I haven't experienced too often. So I think it's a very real shift of investors, their risk taking and their perceptions of emerging markets. And South Africa is pretty well placed in that regard. And I think some of it is the credibility of the Reserve Bank. As we all know, they unfortunately hiked 25 basis points last week. This is after the beginning of the year. We all went out to say we're going to get 2 interest rate cuts in 2026, but there was a strategic shift in the oil price and inflation. So I think that's going to continue. Lesetja and his team have done a fantastic job at building up the credibility of the SARB. We've now got a new inflation target of 3%, which means they're going to be tough on inflation for now. And our expectation is that July, if things stay where they are now, July we should have another a second interest rate hike, also of 25 basis points. And then they'll probably have a look-see and maybe pause for a meeting or two and just see if they can anchor expectations a little bit lower. So it's not a great outlook from that side. The good news from South Africa is the platinum and gold prices, even though they've come off their highs, are still very elevated. And National Treasury has done a fantastic job in putting a very conservative budget together in February. And thankfully, they didn't bank on these commodity revenues. And we estimate that there's anywhere between 50 and 75 billion Rand that they will collect from our mining companies in royalties and taxes in this fiscal year, which gives them some wriggle room. So it allowed them to give us a little bit of relief on the petrol prices. They've taken some of that away this month. But at least the consumer wasn't hit as hard as they could have been. And it gives them a little bit of wriggle room if this war sort of continues. So fiscally, we remain very sound. And not surprisingly, Moody's gave us a ratings outlook upgrade a couple of weeks ago, and that was followed on from S&P that actually gave us a full upgrade of our rating end of last year. So fiscally, we're very sound. Reserve Bank, a lot of credibility in that regard. So that all bodes well for that trend you mentioned of the diversification into emerging markets. So, looking pretty solid there. You did mention the little thing called an election. When I've been traveling around the country, it is causing some anxiousness. I think what we've got to realize is it's very regional. Unlike the national elections, which have got ramifications of who runs your government, what happens to economic policy, what happens with health policy, etc., local government elections are very different. And you just have to travel around the country to realize that. And I think what we're focusing on is more the what I call the swing areas, and that is KZN and Gauteng. If you look at Limpopo and Eastern Cape, those are solid ANC. The by-elections have been going that way. If anything, they're increasing the majority. So there's going to be no shift in those two provinces. I think it's safe to say the Western Cape will be very similar. DA is quite well entrenched, and things are likely to continue in that fold. So there's no point focusing too much on those regions. KZN is a very interesting province. We've got a coalition government in the province that is only there by one seat. So it's MK, we know, is making a full-on run for various municipalities. So you could see a shift there in Durban and Pietermaritzburg, but it's going to be a very close call. IFP has also been building their momentum there, so a very crucial. It's our second biggest province population-wise. If you think of all the ports, you've got Durban Port and Richards Bay ports are very, very strategically important for South African trade. And then obviously, our financial centre, Joburg, that is a crazy election. Nkumi, our colleague, he calls it the rumble in the jungle. You've got Helen Zille, you've got Herman Mashaba, and the ANC are desperate for a big name candidate. They've advertised that they will take anyone. If anyone's on the call wants to be mayor of Joburg, they are looking for applications. It's open to the public. You don't have to be a member of the ANC. So far, they've approached quite a few senior ANC members, and they've all said, no, thank you. Don't want the job. It's too much of a mess. So it's going to be very interesting to see who they come up with. And it's a crucial election. So I think that part is what we're going to focus on is just those two provinces. And then shift into a little bit of positive momentum again, and that's in our state-owned companies. Eskom continues to do very, very well. I think we close on 400 days, so over a year of no load shedding. A year or so ago, when we started predicting this, everyone laughed at us. So thankfully, that's come through. A lot of private generation of private capital has gone into it. Operation Vulindlela has done a fantastic job in fixing Eskom. And now the focus has shifted to Transnet. And even there, we are seeing improvements for the first time in many, many years. So in the fiscal year that's just finished, they reported an increase in tonnage on their railway lines and handling in the ports up about 12%. And that is the highest number of containers handled in the ports, and the tonnages on our railway line is higher than it was. It was the highest in 15 years. So it is a material turnaround. So off a very low base, but the momentum is there. And we once again, and importantly, we are seeing private enterprise getting involved. So ITCSI is putting about 11 billion rand into Durban Pier 2 Harbour. That's the port that handles 54% of every container in and out of South Africa. We are seeing a company called FPT building a fresh produce cold storage unit in Durban as well. And Transnet infrastructure manager 2 weeks ago officially signed contracts with 11 rail operating companies, so private companies that will be running private locomotives and running stock behind them, and we should start seeing those operating on our lines within the next 6 to 12 months. So some exciting news in that regard. Still a lot of challenges. So, the picture that you paint for South Africa, we've got challenges, but we seem to be working through them. So the outlook is actually quite exciting, John. I mean, it's as I said, our bond market has been quite well behaved. Despite the craziness of the picture you painted internationally, our politicians behaving a little bit better than some of those in your region and in America. A little bit more predictable, which is not something we've ever been able to say to you in the 25 years that we've worked together. So I would say the outlook for South Africa is uncertain in the short term, but quite good in the medium to longer term.
You're making me jealous of transformational politics and stable leadership. The UK definitely could do with some of that. Maybe we'll get some. Politics globally is crazy, and pretty much every leader is close to record lows on popularity metrics. So I think we're going to see quite a lot of political change. In the US, obviously, one of the factors coming up is the midterm election, which may begin to crimp some of Donald Trump's power, which I'm sure most of the rest of the world will be pretty pleased to see. But it's an open contest still. We'll see how it goes.
Yeah, I mean, it really is going to be, and that comes in November. It's pretty much the same time that we'll be going through our election. So I think October, November, we can expect a bit of volatility locally, and I think we'll get quite a bit of volatility around that time with the speculation of those elections. So just when we thought we couldn't have any more craziness, I think it's only about 4 or 5 months away before we get a couple of more wobbles potentially to the market.
There's a Mark Twain quote which goes something along the lines, I'm going to misquote it, that November is the most dangerous time to invest. The other times that are also dangerous are January, February, March, April, May, June, July, August, September, October, and December. But anyway, it's a bad joke, but I think people need to be pretty focused on where there's value, where there are opportunities, where the stars are aligned. And there are definitely opportunities out there, but it probably requires a little bit more nimbleness and thought than it perhaps has done for the last few years.
Yeah, Dan, and I think a little bit of patience and circumspection. Greed, as we know, is a horrible thing. Don't worry if you missed one or two little trends. As you say, have circumspection and be careful out there.
Great. And I guess on that note, perhaps that's a good place to pass back to our Sanlam colleagues to carry on the presentation.
Thanks, everyone.
Yes, thanks, John and Malcolm. Appreciate it. Donnie and myself, Donnie van Zyl and myself, we'll take you through some of the performances of the funds that have been happening in the last while. So we can get the presentation up, then we can start with that. All right, so from a market perspective, you heard some of what was being said earlier, but the last 12 months has actually been very positive for risk assets, particularly from South Africa's perspective. I mean, you can see over 1 year that the local market has done just over 30%, which is a very strong return. And actually post-COVID, so if we take the last 5 years, the equity market locally has done about 15.9%. So it's been a very strong risk-on period post-COVID now. And so returns have been fairly strong. You can see also from a global equity perspective, over the last 12 months, the ACWI delivering 17% with emerging markets up 22 or 21-ish, and developed markets only up 15. So emerging markets over the last 12 months have actually outperformed developed markets, which has been for the first time in a while. A lot of the heavy lifting in emerging markets has been done by some of the semiconductor and chip companies, so the likes of Taiwan Semiconductors and the like. So it's not different in that context from the rest of the world, which is experiencing a very much AI-driven market and what's been happening. But as an investor, at the end of the day, it's been positive. So you probably will have noticed some good performance off of your funds. So if we move on a little bit, just to explain some of the trustee approved defaults, there's essentially 4 life stage models that come with the various defaults. So you either in the Sanlam life stage strategy, the passive life stage strategy, both of those portfolios follow a strategic asset allocation approach. So they determine a good strategic asset allocation through the long term, and they tend to stick reasonably close to that. You get the Sanlam Blue life stage strategy and the Sanlam Wealth Creation life stage strategy, which are both peer group orientated strategies. So their objective is to try and beat the average balance fund out there over the long term. The Blue life stage strategy is only allowed to select from Sanlam capabilities, which include 91 now that the deal has been concluded. And then the Wealth Creation life stage strategy, which is a more multi-managed strategy. So those are your more accumulation phase vehicles in the trustee approved defaults. So the umbrella fund, you can select one of those as your default for the accumulation phase. And then on the protection phase, you have 3 landing portfolios. But I think it'll be easier to explain that on this slide. So essentially, you can see the accumulation phase. So the trustee defaults, one of the 4 that we mentioned before. Then, so that's for 40 years. Then 6 years or 7, 8 years before retirement, 8 years before retirement, essentially you get 50 monthly switches from one of those accumulation phase portfolios into one of those 3 landing portfolios. Now, those landing portfolios are obviously designed to try and protect you as well as they possibly can, dependent on the type of annuity that you're going to buy, whether that's a life annuity, a living annuity, or an inflation-linked kind of life annuity. So one of those 3 landing portfolios then does that. The 50 monthly switches is really important because the trouble is what happens is if you have, unfortunately, your birthday, usually how it used to work with these life stage models, and the wrong date, and suddenly the market crashes or rises very quickly and you get switched, you miss out. So the Sanlam Umbrella Fund has taken the view that in order to mitigate some of those risks, it's better to kind of switch you slowly over a longer period. And that really then mitigates the risk that your birthday happens to just fall on an unlucky date when the market suddenly rallies and you've been switched out of the market. So that is a really important step just to note that is how the umbrella fund then works those monthly switches and then into one of the landing 3 portfolios that you've taken, bearing in mind that there is only one landing portfolio, but you select one of the 3, like you select one of the 4 accumulation phase portfolios. So if we look at those 4 accumulation phase portfolios, so the top 2 portfolios against their strategic asset allocation benchmarks, you'll get a sense for where they stack relative to peer group. So you can see they've been fairly close to their strategic asset allocation benchmarks over the 3, 5, 7 years and onwards. It's been a challenging environment for active management, particularly on the offshore side. You will have known that a lot of active asset managers have been underweight the technology space globally. And so offshore active equity has been a detractor. So in the Sanlam accumulation portfolio, there is a component of the fund that uses offshore active equity because that's more actively managed portfolio versus the passive lifestyle strategy, which is 100% passive and indexation. So in that context, I mean, over 3 years, they look like they've performed the same, but that's been driven on the active side primarily by tactical asset allocation as well as very good alpha in the local manager space relative to the offshore space where it's been fairly poor. We do obviously think that comes to an end at some point and that active managers start outperforming again because the market's been driven by a very narrow set of stocks. But in general, the portfolios have been very close to their strategic asset allocations. The Sanlam Wealth Creation portfolio relative to its benchmark, which is the peer group, has done fairly decently over the last 12 months and 5 years. lagging a little bit over the 3-year period, but in general, quite strong performance. The one laggard has been the blue portfolio, which has probably lagged more than the others, except over the last 12 months. So there have been some changes in that portfolio, I think about 18, 19 months ago, which has really resulted in some really strong performance coming through. And we're starting to see that. So the decision was made to change some of the underlines, and that's really started to work. So we're starting to see some really good performance coming out of the blue life stage accumulation portfolio. But in general, what's more interesting, I guess, is how they are doing relative to the various peer groups. And we can see that here. So this is the umbrella fund defaults relative to other large umbrella fund strategies. And what's really pleasing, so if you look year to date, at the top of the table, Sanlam Accumulation, Sanlam Wealth Creation, very high up. If you look over 3 years, Sanlam Accumulation, Sanlam Wealth Creation. If you look over the longer term, 5 years, Sanlam Wealth Creation, Sanlam Accumulation. So over the last 12 months, maybe a little bit of a blip where we're maybe more in the middle of the table. But in general, over the longer term, the Sanlam active multi-managed default portfolios have really delivered very good performance relative to other competing umbrella fund life stage strategies. And so that is really pleasing for us to say as the Sanlam group that the consistency is there, and it means that you can hopefully rest well at night, given that these are trustee default portfolios. If we look at the passive range, again, you'll notice we're obviously looking for the Satrix one. Over 1 year, it's in second place. Over 3 years, it's top of the pops, and in 5 years, it's also second. So again, the consistency with which these solutions are built is really good. We follow a process where every 2 years, the strategic asset allocation for the Sanlam Accumulation portfolio and the Satrix Enhanced Balance Tracker are reviewed. It's part of the, we think, benefit of making sure that these portfolios are positioned for the next 5 to 10 years appropriately, because markets do change. They change very frequently. And it's something that we have to take into account when valuations are elevated. So changing a strategic asset allocation is also part of the benefit of being partnered with the Sanlam in this respect, because it's a deep exercise that we go through. And you can see the consistency with which that comes through in numbers like this, because the passive fund follows that strategic asset allocation fairly well. And so, that's part of the benefit that I think we've got over maybe some others. So I'm going to hand over to Donnie for the preservation phase. So Donnie, over to you.
Thank you very much, Paul. Good morning, everybody. So I'll be taking you through the preservation phase and also the protection strategies. So these are quite important portfolios, especially for members close to retirement and very close to my heart. So if we just look first at these solutions, we like to think of these solutions as our four-wheel drive solutions. Now, the benefit of four-wheel drive, if you drive over loose sand and gravel, all those kind of things, is your backside of your vehicle doesn't slide from one side to the other. It gives you more grip even when the traction is low. Now, in the same way, these portfolios provide more stability and control to members' retirement savings, even when markets are volatile. And this is especially important when members are close to retirement. And because most South Africans, their retirement plans are not robust enough to survive a lot of volatility just before they actually get to retirement. Now, similar to what Paul showed, Paul focused on accumulation phase, and then members move over to the preservation phase in our life stage strategies. Now, I always like to tell clients, irrespective of your flavor of your life stage strategy, whichever accumulation portfolio you use, the end phase or landing phase is the same for all of them. So 6 years before retirement, 72 months, we start moving you across to the preservation, capital preservation portfolio. In 15 months, you switch it. So that means from 72 months through to 22 months, you're being moved across. Every month, a portion more moves across to the capital preservation portfolio. And then only for the last 22 months, you fully invested in the capital protection portfolio. So it's a very gradual, and as Paul mentioned, there are benefits to it and not moving all your money in chunky amounts across. So we looked at what is the most optimal way of doing it so you're not impacted by shorter market volatility, and this was our solution. So close to retirement, members are then in the capital protection portfolio, And we can see this portfolio has done really well over the last while. For a more conservative portfolio, benefited from the good equity performance over the last year in 2025 and even the last 12 months. I know March was a bit difficult, but even so, you can see the performance there and the blue bars, whereas the CPI plus 3.5 is the green bar, and it's handsomely outperformed that even over the long term. At the bottom, you can see just the real return. So that's just the return minus inflation. You can see inflation plus 8% growth over 1 year. Now, that's a very high number for a more conservative option. So please, I think when you're communicating to members and employers, please temper the expectations. They shouldn't expect inflation plus 8% every year. More longer term, you can see the 5-year and the 10-year numbers. We should expect something like inflation, plus 3.5 to 4, probably more closer to 4 over a 10-year period. And that's what members should expect over the long term. And once again, the benefit of this portfolio is it doesn't provide negative returns, or hasn't since we launched the portfolio since 1986. And that provides a lot of comfort to members and can retire with confidence, knowing that their money is well looked after, irrespective of what type of annuity they intend to buy at retirement. Now, we do sometimes get questions about why do we use this capital protection portfolio. So the underlying of that is a smooth bonus portfolio. It protects capital, has nice, stable, predictable returns. And as I said, that's very important for investors close to retirement. Very few of our members actually know what type of annuity they want to buy at retirement. And I mean, one of the obvious questions we always get is, why aren't you putting all your money into, for example, a bond portfolio? Well, that might work if you're going to buy a guaranteed life annuity, but most members don't know that. Most members don't know whether they want inflation-linked annuity, whether they want a living annuity, or perhaps a combination of both. So we do find that our capital protection portfolio provides a good all-round exposure. It's exposed to a lot of diverse exposure to different asset classes that all protect you against market downturns. So it's really a utility portfolio, like you have a utility pack in rugby. They can play in different positions, and it's there to protect members and help them, irrespective of what type of annuity they intend to buy at retirement. Then just turning our attention to the protection strategies. As Paul mentioned, we have 3 options here, and this really provide members with different levels of capital protection. We start with our most conservative one of the highest level guarantees, the Sanlam Secure strategy. So this is a strategy where you get a monthly bonus and you can never, ever have a negative return, irrespective of market conditions or anything like that. It is therefore also our most expensive option, and I think clients need to think carefully whether it's appropriate for their membership profile. Then we have the Sanlam Stable strategy. This is our middle of the road one. It's the same portfolio underlying the capital protection we have on the last stage side. And really, it is there to provide smoothing and guarantees. There are monthly bonuses that members receive. There's a vested and a non-vested bonus. And things go really, really badly, I can take away some of the non-vested bonuses. But crucially, we've never done this since we launched this underlying portfolio in 1986. So you can think this portfolio has been through various market crises, and we've never had to take a non-vested bonuses away. And this is also the reason why the trustees were quite comfortable using this portfolio as an end stage in all the life stage strategies. Not having a fully guaranteed like the secure strategy just means it's a lot more less expensive and more palatable for members as well, the total investment costs. And then on the right-hand side, we have something slightly different, the volatility protection strategy. So here we partner the conservative monthly bonus fund with the Satrix Enhanced Balance Tracker Fund, a very aggressive tracking fund. So here the focus is not really on capital protection from month to month. Here the focus is purely on reducing volatility. So there can actually be some negative returns on a monthly basis, but the idea is that over a 12-month period, it will be very unlikely that you have a negative return. So that's why we have 3 different strategies, focusing on 3 different needs and 3 different types of clients. Just looking at returns is always a more interesting part. You can see the good returns over the 1 year and 3-year period. On the left-hand side, you can see the volatility protection strategy done really well. So over a 1-year period, that extra exposure to the Satrix Enhanced Balance Tracker Fund has helped returns, even though it introduces a little bit of intra-month volatility. Then you have the stable bonus portfolio and the monthly bonus fund. You can see all the strategies, irrespective of which one you chose, did very well compared to inflation. And even if you look there over a 10-year period, whether you're in a volatility protection strategy or the stable strategy, the returns have been fairly consistent. But as we expect, the stable and secure strategy, there is a difference in returns. The secure strategy being the more harder guarantee, coming at a bit more of a higher cost, you can see they will underperform the stable strategy over all periods over time. But as I said, members should be very happy, especially over the last year. All these options, no matter which one you chose, did very well compared to inflation, and that's really protected members despite all the market volatility. I know members get very concerned normally when there's market volatility close to retirement. We saw once again members being concerned during March if they know they're going to retire at the end of March this year. But irrespective of what happened in the market, members invested in these portfolios did have the confidence to know that they can retire without seeing their retirement capital reducing due to market. So that's really what we're trying to achieve with all these portfolios. So thank you. That's my story. I'll hand over to Paul just to briefly touch on the member choice portfolios.
Thanks, Donnie, for that. Really appreciate it. So if we go into the member choice portfolios, just to have a look at what is available on the Sanlam Umbrella Fund, you can see in the various categories, there's some categories that have slightly more options than others. There's quite a few options in the moderate aggressive space. That's because the bulk of your time as a member in the Umbrella Fund is spent in that space. And so the trustees have opted to give quite a number of more options in that area compared to, say, the moderate and conservative space where you probably spend less of your time generating your wealth. So there's a full list on the moderate aggressive space of both Sanlam branded, active managed, multi-managed, passive, as well as external managed portfolios, the likes of an Allan Gray, Coronation, 91, etc. So there's a good mix of portfolios available for members to choose from, and we think that that's fairly sufficient. If we look at some of the performances of these various buckets and what's available, so you'll see. Let's maybe focus over the last 12 months. PSG in particular has had a really strong period, followed very much by the passive option. As I mentioned, active strategies globally in particular have really struggled. So it's not a surprise to see the passive option doing fairly well over the last 12 months, all the way down to close to the bottom where you have Denker along with the Sanlam Living Planet Fund, which is very much focused, the Sanlam Living Planet Fund, on ESG. Its objectives, dual objectives to achieve inflation +5, but also to target half of the carbon emissions of the index. And it's the only type of fund in the industry that we know of that does that. So it's got a very specific mandate. And in a year where gold and platinum shares rally, a fund like that is not really going to do very well because it's not allowed to hold those counters. So it's been an interesting space over the last 12 months. There's a very broad set of funds that are in quite a narrow range, and then PSG, which stands out. If we look a little longer term, PSG's continued to maintain that performance over the 3-year period, with then the Satrix Global Achiever, which is a mix of quite a lot of offshore exposure, and then the Satrix Enhanced Balance Tracker again. So passive followed by accumulation have done very well. But so in general, the trustee defaults, again, fairly highly ranked over the 3-year period relative to some of the other external managers, as well as some of the other portfolios that are allowed. So I think fairly decent from that perspective. If we move on to the next slide, we can take a look at some of the more conservative options, the moderate and conservative options. So over the 12 months, the SMM NERF Fund's done fairly well. I mean, that's really because it's a Sharia portfolio. Sharia mandates have a very high exposure to resource counters, and so resources have done fairly well. And that's why it's ended up being top of the pops over the 12-month period. And as expected, cash is all the way at the bottom. So we're in a risk-on period. As I mentioned at the beginning of the presentation, markets have done very favorably. Cash is not a portfolio that's going to generate very strong real returns over the long term, and so it ends up being at the bottom of these types of performance charts over the longer period as well. And you can see that over 5 years, it's also at the bottom. Over the last sort of 5 years or so, the funds that have done fairly well, the Temperance Balance Fund, which is almost like a Sharia fund, but without a Sharia board. It's got similar restrictions to it, so it's done fairly well. And then we've had the SMM moderate and SMM 50 portfolios, both of which have a moderate exposure to risk assets, doing fairly well and achieving way in excess of the inflation plus 5 that the SMM moderate fund is trying to achieve. So in general, the portfolio performances have done quite well overall. Markets are obviously, as you heard from the two gentlemen at 91 earlier, we're in a bit of a flux phase at the moment when it comes to markets. The conflict in Iran, despite that, markets have continued their upward push and trajectory, particularly on the global side. The US market, as an example, has actually recovered all of its losses that occurred from the Iranian conflict and have surpassed and reached new highs. On the South African side, we are not at the highs that we were before the conflict started. So we are not a country that has a lot of chip manufacturers and the like, which has really been driving markets the last 2 months in the war. Our market was driven heavily by gold and platinum, and the gold and platinum prices come off slightly during this conflict. And so our market hasn't recovered to the same extent. And in addition, the increase in petrol price obviously puts some pressure on company earnings to the extent that it has. So our market hasn't recovered to the same level that it has. But if you just take a step back and look broader, markets have been predominantly positive. It's not a space where you want to be underweight risk or de-risking or panicking. If you'd panicked over the last 5 years, you would have missed out on a lot of very good performance. And there's been a lot of interesting events that have occurred over the last 5 years. I mean, we had the Russia-Ukraine conflict, which started in 2022, which was within the 5-year period. We had a global bond yield increase, which was heavily negative on global bonds and interest rate sensitive type counters in 2022 as well. And so we've had a lot of events, if you include COVID, over the last sort of 5 to 7 years, where you would have thought the market would have taken heavy punishment, and actually the opposite has been the case. Markets have continued to rally. So sometimes it's important just to spend time in the market rather than worrying about when to get in and out of these things. And know that you've got portfolios that are working for you whilst you do your own job every day, and that the investments work very hard to make sure that your retirement is a dignified one and that those members are able to retire in a dignified way. And we think the Sanlam Umbrella Fund's options are performing really well compared to the industry and relative to peers, and are offering that safety and security net and peace of mind in order to hopefully let everyone retire with dignity. So that's it from us today. I just want to ask you to stay online to take a quick poll at the end of this. It'll help us for future events. So if you're able to do that, we'd really appreciate it. But otherwise, we wish you all the best, really well for the rest of the year, and good luck with all your endeavors.